All right, so here we are, the last part of Chapter 8. And I don't think this one is going to be too lengthy. There's not, it's just more of a wrap up than new information for the most part. I apologize that it's taken me so long to post this. I had some technical issues, but I've got them fixed now and we're off and running. So here we go. So remember, when kind of in Chapter 8, Part 3, we were talking about tax credits. And remember that the great thing about tax credits is they reduce tax liability dollar for dollar. So they're better than deductions. All right, and we have three basic categories. And remember, we're going to deduct, or we're not going to deduct them. We're going to use them in this order. We're going to use our non-refundable personal first, our business second, and our refundable last. These, if there are unused portions, we get to carry those forward. These can take our tax liability below zero, okay? So we are not going to talk specifically about various types of business credits. We're going to talk about them generally, and then we're going to talk about the foreign tax credit just a bit. So business credits, they're designed to promote certain behaviors. You've got credits for fuel efficiency. You've got credits for environmental savings, those types of things, okay? If your credit exceeds your tax liability, you can carry it back 1 year and carry it forward 20 years. So be sure to know this, all right? That is a big takeaway from business credits, okay? The foreign tax credit. So the foreign tax credit is kind of important because it is in lieu of excluding foreign earned income, and it's a hybrid business and personal tax. So really the only thing you need to know about it is that it is related to foreign income. It is an example of a hybrid business and personal tax. It is not refundable. But again, you're going to carry back 1 year, but its carry forward is only 10 years as opposed to 20 years. So there's a great graphic in your book, and I've included it in these slides. And it gives you, kind of the general layout of which order you apply credits and what happens to, we're going to call these unused portions. All right. So for non-refundable personal, that unused portion is just lost. It's gone forever. You never get it back. Business credits, you can carry back 1 year, carry forward 20 years for most. Remember, you've got that foreign tax credit that only carries forward for 10. And then the best situation is to have a refundable credit because that can take your tax liability down below zero. So that's the best situation from a credit perspective. Okay, now we need to talk about kind of prepayments and filing requirements, all right? And remember that taxes are designed to be pay as you go, and they do this to improve compliance, all right? So the withholding system is designed to improve compliance because if the federal government withholds your tax dollars and then you complete your tax return at the end of the year and you're due a refund, or you think that if you complete your tax return at the end of the year, you will be due a refund, you are more likely to complete a tax return at the end of the year, as opposed to if you knew you were going to have to pay the government your full tax bill at the end of the year. So we have this withholdings system because it increases certainty for the government. So if we think back to Adam Smith's tax canons, certainty being one of them, withholdings makes it easier for the government to plan. Okay? So if you are an employee, you have withholdings. If, however, you are self-employed, you are required to make estimated tax payments. And they're due on April 15th, June 15th, September 15th, and January 15th of the following year. And so what do? You essentially estimate what you think your tax liability is going to be based on what your estimated amount of income is. And there are different formulas that you can use depending on your situation. You do not need to know that. You just need to know who uses these. Okay? So remember, self-employed persons, or if you have large capital gains. Okay? What happens if you don't pay the amount that you owe? Well, you end up with an underpayment penalty. Okay? They're applied on a quarterly basis. They're based on the amount of underpayment at each quarter. So that's kind of important to know. And so they are, you do get charged interest, and it's the federal short-term borrowing rate plus 3%. So it's not a taxpayer-friendly rate. And the thing you should know is that penalties are not deductible. So if you have penalties related to your state income tax, at least partially, is deductible. Penalties are not deductible. All right, we've talked about filing requirements before. Typically, you have to file if your gross income is larger than the standard deduction and the personal exemption amounts. And remember, these things can be found on our tax rate sheet. All right. If you're married, filing separately, you must file if your gross income is larger than the personal exemption amount. So this right here means that you have to file, I don't want to say more frequently, you're more likely to have to file. It's a lower threshold, okay? And then there are lower thresholds for those claimed as a dependent on someone else's tax return, all right? We know the standard due date is April 15th, okay? We know you can automatically extend the filing, but you cannot extend the due date for paying taxes, okay? And then finally, the last slide in Chapter 8, late filing penalties, Okay, so you have a late filing penalty of 5% of tax owed, per month, up to 25% if not fraudulent, but it's up to 15% of tax owed per month, up to 75% if it's fraudulent. Okay, no penalty if no tax is due. So if you filed late but you were owed a refund because no tax is due, then you do not have to worry about a late filing penalty because you're not withholding any of the government's money. Okay. A late payment penalty, all right, if you don't pay the entire amount of tax owed by the due date, all right, you have a similar penalty structure. Okay, it's important to know that combined late filing and late payment penalties cannot exceed the maximum amount for either one. So there are limits to how large of a penalty you will be required to pay. That is it from a PowerPoint perspective for Chapter 8. I will also, in our Zoom meeting, I will do practice problems, and then we will talk via Zoom, hopefully. All right. Have a good night, y'all.